Dipen Sheth, Head Institutional Research at HDFC Securities, joins us. Dipen, good morning. Thank you very much. Are you getting a sense that we could be ripe for a correction, or do you think the correction, such as it is over?
I don't know what you mean by a correction. If it's a couple of hundred points...
We came down from 8,200, so it's a 350 point fall.
200, 300 points off the Nifty in an 8,000 kind of regime. Stock markets do not move in a straight line, and there's always going to be a little bit of a push and a pull once in a while. So I don't see what the
can it broaden, because there is a lot of chatter that the Modi honeymoon is over and that the government has not done enough to sustain the magic.
So honeymoons do get over. They don't continue forever. The business of marriage is messy, and the nitty-gritties will start.
Does the Nifty go to 7,000, say 7,400 or 7,500? Can the correction get that?
So another 200, 300 points is not ruled out, because the Nifty is a composite of various kinds of stocks, volatile and not so volatile, secular and not so secular, cyclical and not so cyclical, government policy dependent and not so government policy dependent, and so on. But you have to keep in mind that any correction that the Nifty that will set in the Nifty at this point of time will be seen by solid long-term India investors, particularly index investors, as an opportunity to enter what is clearly a magnificently healing economy and investing story. So I don't see where. So it's this classic trade-off or conflict between weather and climate. The weather could get a little murky once in a while, and it's not even anywhere near murky right now. It's just that you had a straight line kind of run up, and there's a little bit of a sell-off. People are booking profits, and some unrealistic valuations are probably giving way. So I'm okay with this. I don't see the big India story as having changed materially at all in the last few months.
Hi Dipen, good to have you today, and good morning. The big story of the last 1 month has been the decline in crude prices as well as in various commodities. So how have you altered your portfolio to account for this? Because on one hand it's negative for commodity linked stocks, but it's positive for sectors and stocks in which the commodities feed into, acts as an input, like say cyclicals like autos.
Oil prices coming off is structurally good for India. Commodity prices coming off is structurally good for India. Apart from the developments such as elections and the new government and a pro-business tilt and the promise of better governance and so on and so forth, any reduction in commodity prices globally is going to work to India's advantage, because we are a net and a very large net importer of commodities. So I don't see where the worry is on that count. The second thing is that fuel prices were kept artificially low through government profligacy, which was reflected in fiscal deficits. And if commodity prices come off, fuel prices need not necessarily come off. You might see a minor adjustment here and there, and that is what has happened. That a 12-13 rupee under recovery in diesel has gone to zero and perhaps even negative.
It's a gain of 3 rupees.
Yeah, so maybe some past sins can get made up a little bit. I don't think we should reduce diesel prices at this point of time. But the bigger picture is that macro healing will set in magnificently here, and this promise of bringing the deficit to 4% or thereabouts and then finding a path which takes it meaningfully down from there as well becomes that much less challenging. The industries and sectors that lower prices of commodities feed into, more than autos, I would say sectors like construction would gain, because I suspect lower steel prices would have a salutary effect there. Steel is also a globally traded commodity, so it's very easy to get in large bits of, large amounts of steel into the country should that be required. Although we do have very, very competitive manufacturers of steel in this country as well. So whether it's not so integrated player like a JSW or an integrated or mostly integrated player like Tata Steel's Indian capacity. So I don't see commodity prices coming down as being bad at all for India. I think it's very good news.
Oh, absolutely. We've discussed a lot about large caps, and we will come back to them time permitting. Let me come to mid caps. Do you see the outperformance continuing? And rather than the macro, identify for us some of the more or speak to us about some of the more interesting stocks in your list. We haven't heard so much about Sanghi Industries. LG Balakrishnan, yes, but you see it as the relative outperformer in that auto anch space.
So I would disagree with you. I have spoken on your channel earlier about Sanghi Industries, but be that as it may, I think the larger picture to look at in the mid-cap space is to obviously find companies which are aligned with this cyclical and structural healing in the Indian economy. Some of the stories in the classic domestic cyclicals such as auto and cement do arguably look fully valued as of now. So it's surprising that we should be talking about stocks like LG Balakrishnan or Sanghi and what have you. So on Sanghi specifically, the story is that for years they have been an over-leveraged and underperforming company, but over the last 3 or 4 years they have steadily and I would say generated enough cash to be able to partly and slowly retire some of the debt overhang that the company, that the balance sheet was creaking under the weight of. Also, it must be kept in mind that the biggest issue in setting up a money-making cement venture in this country today is the access to limestone and the access to large bits of land where you can keep on expanding capacities. On both fronts, Sanghi is very well positioned, and I think their limestone deposits would support a 10 million ton capacity versus the 2 odd million that they have as of now. And there was also, so there are specific stock specific or issues at Sanghi which made the stock optically look optically worse than where it was really. So for example, they have a cement and clinker mismatch. This is one company which has more clinker capacity than grinding. So they're putting that right. This was a company which was at an odd location, which was suffering from the burden of a high transport cost. They're looking into that and investing in seaborne transport and so on. So I think there are multiple levers which are playing out at Sanghi, and no wonder the stock has kind of doubled in the last 3 or 4 months. So where are you? And even now, I would say if you look at nameplate capacity, yes, on EV per ton they might look fully valued, but versus what they can do by retiring debt or retiring part of the debt and then reinvesting into building more capacity, knowing that adequate limestone is available and the market is going to support them in terms of prices, I think this is actually a multi-year story.
Okay. I'm reading your note where you say domestic cyclicals like autos and cement have hit in near-term peaks. So if someone has a 6-month time horizon, you would recommend profit booking?
In many cases, yes. For example, in Sanghi, no, because you know it's not a particularly liquid stock, and you don't know whether you can get back inside. So I don't know whether it's around 60 rupees or something, and that makes.
What about large cap auto and cement names? Which stocks would you recommend?
So in autos and cement, for example, I think some of the reset or much of the reset at Maruti is already played out, and I'm not too comfortable at these valuations. It doesn't mean the company is bad or that the business won't go anywhere, but I think Diwali sales should see a little bit of a disappointment unless I've got something terribly wrong here. And much of the delta is already built into Maruti's price. And remember that PVs as opposed to two-wheelers is far more of a cyclical and discretionary spend nature. I would put two-wheelers somewhere close to FMCG in terms of the kind of demand distribution and the broad-based demand that they have across the country. And it's there that Hero MotoCorp's valuations, although they might look similar to Maruti's at the current point of time, look much more attractive.
Okay. For the next 12 months, what would be the best Sensex candidates or the Nifty candidates?
Given the fact that we have arguably a very, very high quality government in place now, and there's virtually no doubt on that, so we can crib about the fact that there's too much of talking going on. But I think when you run a country, when you run a government, these things take a while to turn around. It's like you don't turn a government around the way you turn a scooter, for God's sake. So we need to be patient with them. So all the large PSUs out there are natural candidates for re-rating, not over a 2 or 3 quarter horizon, but over a 2 or 3 year horizon. So whether it's a State Bank, whether it's a Coal India, you name it, whether it's an ONGC, whether it's a Power Finance. So all the large caps out there are going to attract re-rating, and many of them have attracted re-rating. There's been a sell-off lately in State Bank given the larger worries about asset quality and the outcome of Colgate.
I must squeeze the money control question in, or we'll anger our money control viewers.
Yes, sure.
This question has come from Barun. He's writing from Bangalore. Wants to know your call on Walcott. And while at it, why don't I squeeze in your picks, Alembic Pharma and Indoco Remedies as well?
Lata, Pharma is a story like IT. We have deep skills in this area as a country. And we've repeatedly shown that we can beat the rest of the world at this. And I'm probably saying this for the 40th time on your channel or some such thing. So when a pharma story is in alignment with the bigger picture on what India has to offer in pharma, and that is, world-beating ability to penetrate and, achieve success in critical markets, high price markets like the United States, then you just go and buy those stocks on a limb. So I don't care that Alembic Pharma has kind of become 4x over the last year and a half or something or that, and so has Indoco. Now Wockhardt we don't have under coverage, and they've so a few years ago they went through a gut-wrenching financial implosion of sorts on their forex exposure. So I'm not very highly qualified to comment on Wockhardt, but on Alembic and Indoco, my contention would be that despite the run-up, these are fundamentally good stocks, and they are all available at 15x or south of 15x. On 1 year out basis. And if you look at, for example, Indoco is going to, in the next 3 or 4 years, their US revenues are going to go up 5x. Similar things playing out at Alembic. So there's no reason to get scared on these stocks at all.
All right.